Welcome to the Morrison Report. Hosted by Deval Morrison, sales representative for Bosley Real Estate Limited Brokerage. Ms. Morrison has co-authored the best-selling book, Success Today, with Brian Tracy, and has been interviewed on NBC, ABC, and CBS affiliates by Bob Guinea from The Bachelor. Deval, a real estate investor, has spoken to many attendees at her real estate seminars and is currently ranked in the top 5% of agents in her brokerage. Join me in welcoming your host, Deval Morrison.
Welcome to the Morrison Report. I wanted to create a podcast that would give people insights into the Toronto real estate market. You can follow me on Twitter at Deval Morrison and on Instagram as Deval Morrison, and you can like my business page on Facebook. Today we'll cover everything you ever wanted to know about taxes and your real estate. If you have any questions not answered here, please reach out to us and let us know how we can help. Today's guest is Daniel Toma. He's a chartered accountant. Welcome, Daniel.
Hi, thank you.
Awesome. One of the reasons I feel it's important to invest in real estate is because of the many tax write-offs it gives you. Daniel, can you tell us what are some of the things that people can write off if they have a basement apartment or another suite in their home that they rent out?
Sure. So if somebody's renting out a portion of their home, they would basically be able to take a portion of all the expenses related to the home for the portion of the home that they're renting out. So we would usually determine that either by area or by the number of rooms in the home that are in total, and we would take just the rental number and divide that. In terms of the expenses, you would take things like, if it was a condo fees, but if you're talking about a home, there would be mortgage interest, mortgage insurance, property tax, all the expenses, including utilities, all the expenses that you're incurring for that home. We would take that percentage and then allocate it to the rental expenses. That can also include additional expenses such as advertising for the unit being rented, legal accounting if you're getting accounting done on an annual basis, and then any other fees that might come up. And we'll talk about this a bit later, but you would not want to take depreciation most likely on that portion of the property because there are some adverse tax consequences.
Okay. Good to know. Absolutely. Actually, do you want to tell us now maybe what some of those first maybe tell us what depreciation is and tell us what some of those adverse tax consequences might be?
Sure. So depreciation is basically taking the cost of a property and allocating it over time. So if it's a rental property, you could be taking up to 4% a year as additional expense based on the full value that you purchased the property for. However, there are two things to consider here. If it's a home that you own, you would also be qualifying for the principal residence exemption when you eventually sell it, which is basically allowing you to sell your home tax-free if you meet all the criteria. If you're claiming CCA on that portion of the property, it will not be included in the principal residence exemption, and you will be subject to tax on the gain for that portion. So especially in this hot real estate market, there's a lot of value in terms of your home going up in value. So it's not advised that you'd want to pay tax on that just to claim some extra expense on the depreciation portion. Yeah, so that's pretty much the main reason why we advise not to take CCA on something like a basement apartment.
Got it. Okay, thanks. That makes a lot of sense. Was there a recent change, by the way, in the taxes for the way the CRA views the principal residence for 2016? Was there a change or adjustment they made?
Well, the change has been that they're requiring everyone to disclose in the principal residence exemption form, whereas before they were just not requiring you to file it every year. Like if you're selling your home, you weren't required to submit to them. And now, because there's so much of this hot activity going on, they're actually tracking. They want to see every transaction. They're going to, if you're claiming the principal residence, they want to see that included with your tax return. So it's definitely becoming more under the radar whether somebody is going to qualify for the principal residence exemption, and that is the main difference in 2016.
Interesting. So what kind of documentation does someone need to submit then to qualify for that principal residence exemption with that documentation you're talking about?
Well, it's included kind of as just an additional tax form. However, if CRA wanted to see documentation to support your claim, which is going to be a lot more common now that people are more commonly flipping properties, they would want to see, original purchase documentation, assess how long have you been living there, was it actually your principal residence, for instance, is your driver's license listed at that property? You have to have a case that you've actually been living there, because there's some people that are claiming, because it's a very valuable thing to claim that tax-free status when you sell property, maybe claiming something that they didn't actually live there long enough. They lived, they bought a condo and then within a year they resold it and didn't want to pay any tax on it. CRA is definitely watching that a lot more closely and can disallow it.
Interesting. So is there a particular amount of time that you should live in your property for before you can claim that principal tax exemption? Is it 6 months? Is it a year? Is it even defined?
There may be a definition somewhere. I always advise clients to stay there at least 2 years. Like it's kind of a safe time period. I think you might even be able to get away with a year, but I'd have to get back on that particular point. But 2 years, in my opinion, is kind of a good safe time range to say that you live somewhere, was your principal residence, and then you're claiming the exemption. But it technically might even be as low as a year. I'd have to get back to you on that.
Got it. Okay. Sounds interesting. What percentage of people's homes expenses do you think that they can write off, and how is that determined when you are looking at an investment property?
Sorry, when you mean they would be owning a separate property and then having a portion of home expenses that they would want to claim?
Or no, if they had like a basement apartment in their property, what's the percentage that they can write off, and how is that just determined?
Oh, I see. Okay. So it would normally be based on the area. That's like the go-to method. But you can also base it on number of rooms in the home. So saying that, that's one room of 6 rooms or something like that. Now, one point that isn't often looked at is you can also claim amounts for shared space based on the available use and percentage of time a lodger might use it. So if you were providing that shared space on some kind of basis, then there could be an argument that it's 20, 25% used by the renter. So it's something that an accountant can discuss with you about what is the best allocation to keep things safe and not like you're excessively claiming expenses in that regard.
Got it. So, for example, let's say I have a basement apartment and I live in a 2-story house. What portion would that represent, you think?
So it's a basement apartment, 2-story house. Like it could often be 25%. Like I'm assuming the basement is kind of a smaller area than the the other 2 floors, but it could be, an area of 25%, something like that.
Okay.
And so that's a good portion of all those expenses that you're paying for the home. Got
it. That makes sense. So for real estate investors that own one or more property, can you explain what things they might be able to write off?
Sure. So it's going to be similar to what somebody is claiming in the let's say the basement apartment. However, if it's a property dedicated to rental, they're going to be claiming everything related to that property. In terms of mortgage payments, you would only be claiming the mortgage interest. The principal repayment is not part of the expenses. So otherwise, though, if you're paying any kind of management fee for a realtor to be handling the property in terms of dealing with the tenants, all those things are things that you're going to be able to expense, property tax, everything related to that property.
Got it. That makes sense. So then for a real estate investor who owns just properties outside of their principal residence, if we go back to the depreciation concept, how does that work when they sell a property? How are they taxed?
Sure, and that's a very good question. It really comes down to the year of sale. In the year of sale, if you've been taking depreciation, there's going to be a lump sum of income added, which won't be taxed at the preferential capital gains rate, but it's going to be taxed at full taxable income. And that is something that will be added as a one-time amount when you're selling. So it's really a personal choice if somebody is wanting to save some tax every year by taking depreciation on rental property, but then dealing with that lump sum of income when they sell, or if they don't want to take any depreciation and avoid the lump sum of income when selling. Now, deciding this can be motivated by how long you're going to hold the property. So if you're planning on holding it for many years and maybe even keeping it into the family, then you may not be as concerned about, having a lump sum included when you're selling, because that's really far off, or not even in the foreseeable future. But if you are going to be selling, let's say within 10 years, then you may decide that you don't want to take depreciation and avoid that income inclusion. So it's definitely a conversation that I have with all my clients who own rental properties. I make sure that they understand the two outcomes so that they can decide what's best for them, and then and make that decision accordingly.
Got it. That makes sense. And I want to just sort of go back to sort of the concept of depreciation, because sometimes I think we sort of talk about it and people are sort of left a little bit confused as to what that actually is. So if we say that someone has a property that's worth $100,000, and I guess is your assumption, let's make an assumption of a 10-year lifespan of that $100,000. Can you explain exactly how much you would depreciate that property so that people have a clearer understanding of how that works?
Sure. So it's not on a straight line method. It's actually what we call declining balance.
Okay.
So if it's a rental property, we could say it would have a rate typically of 4% depreciation. However, each year after you take an amount of depreciation, now your remaining balance is reduced, and then you're taking the 4% on that. So the amount of depreciation is going to go down every year based on the declining remaining balance available to take additional depreciation.
Perfect. So the first year of depreciation is going to be much higher than the subsequent years.
Correct. And in the year of addition, there's often a half depreciation rule that we usually follow. But you're right. In that first year, excluding that factor, in the first few years, I would say you're getting more depreciation than later on. And as the property, as you hold it for longer, the depreciation is much less valuable.
Perfect. That's good. That's awesome. So are there any differences if someone is renting out their place on Airbnb from a tax write-off perspective?
That's a very good question, actually. And I actually have many clients who are Airbnb hosts and have become very much aware of activity going on relating to that topic. The major difference with Airbnb is that it's being considered as short-term rental by CRA. So to answer your question first, they can claim all the same expenses and deductions that you would claim as a normal rental property. They would often have a few other ones, maybe related to more actively managing the property, I would say. But CRA has a view that if a property is being rented out for periods of less than a month, it's classified as short-term accommodation and would be treated as a taxable supply for HST purposes and subject to HST if you are earning $30,000 or more in a year. That's the threshold normally for business owners that they would require to register for HST. At $30,000, CRA says you need to register and start charging it to your clients. So if somebody's doing short-term accommodation and they're making more than $30,000 a year through Airbnb, they're actually going to be required to remit HST to CRA. Now, the problem is that the Airbnb platform in Canada, at least, doesn't really have a mechanism to add HST as an extra line item when you're charging it to your clients.
Oh.
So it's a bit of a problem and many hosts, to be honest, are not even aware of it. I think that there's becoming more of a movement to educate all the hosts about this, but they would need to include the HST in what they're charging to the clients. And they would probably want to disclose the HST number somewhere in whatever way they can, because that is technically the way you're supposed to be invoicing when you're charging HST. You need to disclose your HST number so that the other registrants can claim the HST if they're also an HST registrant. So it has created some challenges, I think, for some Airbnb hosts, and a number of my hosts have actually registered for HST based on this.
Interesting. So for example, I have a friend who recently started renting a place out on Airbnb. So what if he has no idea if he's going to make $30,000 or not this year because it's the first year that he's tried this? So should he just register for that HST number regardless because he doesn't know if he's going to hit that 30,000 gross threshold or not?
I would say no, because it's to his benefit if he is staying under 30,000 because he's not going to be required to register for HST. If he's going to hit I would say that he should watch his income coming in, and then if he's going to approaching that $30,000 mark, then he should look at registering. And once he's registered, you can't go back to being unregistered. Like, let's say he exceeds $30,000 this year and then is under $30,000 the following year. Once he's registered, and he needs to charge it. And